Ted, let's talk about Cazoo, because this all came about when you were watching a football match. I think it was Aston Villa, wasn't it? Or was it Everton?
It was either Aston Villa or Everton. I forget which one, but I'm sitting on the sofa watching Aston Villa with my son, who is he's 19 years old now. God, it makes me feel very old. And we just started to chat about Cazoo, who are their sponsors.
Yeah, and I was surprised to even hear it. I mean, I'm not a football fan of any kind. Actually, I don't really watch the game, but I was surprised to hear that they were sponsoring a football team. And for any of those that are not in the UK, if you're in the UK, you've probably heard of Cazoo. They're an internet car sales business. They're all over the radio, all over the TV. They have their signature kind of yodeling adverts, so it's kind of unmistakable, which kind of is a good thing for marketing, of course. But for any of those who are not in the UK, if you're in the US, for example, similar companies will be companies like Carvana, Vroom, Shift Technologies. So they basically sell, and they focus on used cars, right? Not new cars. So they sell used cars online, and they will either deliver it to your home or you can pick it up at one of their centers. And what I was really surprised to see was they're headed up by a gentleman called Alex Chesterman, and in the UK he's quite well known. He created Love Film, which he then sold to Amazon, and it became Amazon Prime for £200 million. But he also created a real estate website business where they host and showcase all the properties that are being sold by various real estate agents. It's literally almost like a center and hub for real estate agents to put their houses on the market. But he sold that business for 2.2 billion to Silver Lake. So he's a very well-known individual with a net worth of about 360 million. But I was really fascinated, Ted, with what you said about the company and especially their finances. What did you find?
Well, okay, so I think you've pretty much summed up Cazoo there. And it was quite interesting. I'm sitting on the sofa with my son. We were watching, and I'm just going to share my screen with you if I can.
Yes.
The conversation really came out of me sitting with my son saying, Cazoo, there's a lot of advertising. We've seen the adverts, and TV adverts are not cheap. To sponsor a football team is not cheap. I think it's something like Everton is 29 or 30 million pounds over 3 years. So that's a fair sizable amount of money. And I started to think, where are they getting all this money from? And he happened to be sitting there with his laptop on his lap, because that's what kids do these days. They double screen. So I said, have a look at Cazoo. And he looked up, and I told him to look up the accounts on Companies House. And I put the address up the top of this screen. So companieshouse.gov.uk is where every limited company has to provide their accounts. And so what I thought would be interesting is to look at those accounts and see what we can pull out of the figures. Now, as you mentioned, and I've just put on the screen to reiterate some of the things you mentioned about Alex Chesterman. There's a picture of him. So he founded Love Film and Zoopla. So he has a history of startups. He's obviously a very successful entrepreneur, much more successful than you or I so far, although I'm sure my unicorn is in the waiting. And he's managed to raise a lot of funds. There's a list of some of the funds who've actually invested, and they've done a couple of fundraising. So they raised some money, launched in 2019. They've raised additional money in 2020. And what I thought would be quite interesting is to have a look at their business now, and then maybe when the latest set of accounts come out, we can kind of revisit this. So if you go to
just a quick note, they've raised, sure, I think in total about 450 million pounds.
450 million pounds, exactly, yeah. So these accounts are not going to show that. They're just going to show the first part of the fundraising, which I think is about 180 million.
Yes.
And it's a little bit complicated how they've raised it. So I'm not going to go into too much detail, but I want to pull out some of the salient points. So these are the accounts, and really what we're looking at here is the benefit of how much information you can draw from just looking through some of the numbers. So if we scroll through, we see the directors. Here they are. So we've got Alex Chesterman and Lord Viscount Rothmere. So it's quite a small board, and you'll have people like sort of Lord Viscount Rothmere, they will represent the interests of the investors. So there's not a lot of directors. With lots of investors, you might expect lots of investor directors to be sitting there trying to influence it. But I think that they've kind of said, no, you can invest in us, but you're not going to sit on the board. You're not going to influence. Just a quick note, Moeed, you'll notice that the auditors are Ernst & Young, obviously a very good quality set of auditors who I qualified with. So directors report. So we start off with the directors report. Pretty standard, talks about the principal activity. So and I think you summarized what they actually do. And the directors, a little bit about going concern. So there is a little bit about, are they a going concern? They are burning cash at the moment. And I think the way to think about this company is a little bit like the Challenger space rocket. You kind of, or the shuttle. It takes an awful lot of fuel to get it off the ground and to clear the Earth's atmosphere. Once you're in space, you only need a little bit of fuel to kind of carry on your journey. And that's really what this company is all about. There's a lot of effort going on now to create a brand which people are familiar with. And the question is, will they run out of cash before they've actually proved the business model and created the value?
Yes.
The auditors give a clean opinion, which is absolutely fine. And then we jump into the accounts. So now here is the accounts. Now, this is the first year of trading, Moeed. So again, there's not a lot of information in here, but I just wanted to highlight a few things which suddenly made me sit up and take notice. And the first one is these top three lines. So I'm just going to annotate my screen here. So these top three figures here, that's the revenue, the cost of sales, and the gross profit, or in their case, a gross loss. And the cost of sales is the cost of the thing that you're selling. And as you correctly identified, they're selling secondhand cars. So what this tells me is for the first bit of trading, they sold the cars at a loss. They were buying the cars at £100 and selling them for £50 effectively. So they were making a loss on every car that they were selling. Now, they talked today about how their sales have hit 100 million for last year. So these numbers are going to increase dramatically. I'm just hoping that they've managed to up the sales without upping the costs at the same rate, because otherwise they're going to be trading at a very significant loss.
Is it as simple, Ted, is it as simple as the fact that each car, and I know it's averaged out, of course, when you put them all together, but each car is being sold at a loss? But is that also because they've had to buy so many of those cars? Because I think they have something like over 4,000 or maybe more cars in stock that they've bought. Is that because they've had to buy so many that are up front, and that cost is now?
So that's a good question, Moeed, and actually that's a common misconception. So just have a look here. It says here cost of sales. You'll see that there. Okay, cost of sales. It doesn't say cost of purchases, because what happens is that when you buy a car for sale, it appears on your balance sheet as an inventory, as a stock. So you'll still own it. So all you've done is you turn your cash into stock. It only appears in your cost of sales when you sell it, not when you buy it.
Right. Okay? So they really are selling it at a loss. Then it's not anything else. Really are. Simple as that. Wow.
They really are selling at a loss. Absolutely,
and quite a significant one, because it's almost a double the loss, right? So
exactly, it's almost a 50%. It's 100% loss basically. Yeah. So that they're buying a car for £100 and they're selling it for £50, which is crazy. And it'll be interesting. I mean, no business can survive like that. So or very few. There are certain business models that potentially can, but essentially no business can survive like that. And therefore, there's a question mark. So the question is, what's the gross margin that they're now achieving on their sales? So that's the sort of the first one. The next part of the P&L account, these three numbers here, this is the kind of the cost of running the business. So this is the sales, general and administration, SG&A we call it, and they've been very nice and actually split it out between the S, which is the middle one, the G, so they got selling and marketing, and then the G&A, which is the bottom one. Now, marketing expenses. So marketing expenses are quite high. £4 million. Okay, well, they're doing a lot of marketing. They're on you'd expect that. There's clearly not the advertising, the sponsorship of the Premiership coming in yet, because that's a significantly bigger number. So we were talking about 10 million a year just for Everton, for example. The selling and distribution is going to be the salespeople. So those are the people who are on the phone making the sales, and the cost of getting the car to you. So if you've seen the adverts, you'll know, you buy your car on the internet and it's delivered to you the next day. So the cost of delivery, they're actually sitting in there as well. And then the administrative expenses. Now, I have to admit, I'm struggling to kind of get my head around those admin expenses.
That's huge.
That's a big number. That's £11 million. But the point we're making here is that whatever they're doing admin, and I'll come on to that a little bit later on as well. I think I have an idea of where some of that's going.
Yeah, so
the loss from operations is 18, nearly £19 million.
Yeah. Whoa.
They've got some finance income. Well, they've raised lots of money. They stick it in the bank. They earn interest on it. So that's absolutely fine. And then finance expense is the cost of financing the business. Now, it's worth bearing in mind, Moeed, that that sometimes you get companies like this which are financed through debt. So debt is quite an efficient way for an equity investor to also finance through debt. And so there may be some funny ones where, for example, rather than me investing £1,000 in your company, I buy one share for £1 and lend you the other £99 because it's easier for me to get the other £99 out for it. So sometimes that may be a little bit of kind of financial hocus pocus going on, and we can't necessarily see that in these accounts.
Right.
But the point we're making here is that this company, bang, 20 million or 19 million pound loss, okay, in the first year of operation. Okay, now we're talking about a shuttle, a space shuttle, and the space shuttle needs to burn a lot of fuel. If you've ever seen it take off, you think about the fuel it burns in the first minute is phenomenal, and it hasn't even cleared the tower yet. And that's what these guys are doing. They're burning a lot of fuel and they're trying to clear the tower. It'd be interesting to see where they go next.
Yeah.
If we look at the balance sheet, what have they actually been spending their money on? So they've got property, plant and equipment, 8.7 million. And we'll jump into some of the notes. So this is kind of top line. So we'll jump into some of the notes and have a little bit more of a look at this in a minute. The intangible assets are things you can't touch. So they've spent a lot of money, and that's 2.6 million. And that's basically the platform. So they've developed the IT platform for 2.6 million, which is all the kind of, if you've ever been on there, it's all the, how you select your car and what color you want and what are the blemishes and et cetera, et cetera. So that's kind of, it's basically like Auto Trader, but it's secondhand cars and we'll deliver it to you. So it's a consolidation website. And then we've also got a bit of other trade and other receivables. Now, this is, actually, I'm not sure exactly. We'll have to look at note 15 what that is. I was going to say that you might put in trade and other receivables. If you sell a car on credit, it goes in there. But obviously, they haven't made £4 million worth of sales. So we'd have to check that. The cars that they bought that you highlighted, inventory. So there's 43 million. So they got 43 million quid's worth of secondhand cars stashed somewhere. And I'm starting to think whether they've got a tie up with WeBuyAnyCar.com, for example, who buy cars actually considerably cheaper than you can sell them yourself, and they just go, oh, we take the hassle out of it. So this is aimed at people who don't want to have to negotiate, don't trust kind of secondhand car dealers, don't want to do a private sale because they're nervous. They want to buy, they want the assurity of a new car, but they don't want to pay new car prices. That's really their target market. So more trade and other receivables. Again, we'll have a look at that in a minute, find out exactly what's going on. So there's 15 million of people who owe them money, and then they've got this stash of cash. So they've raised the money. They've got 34 million sitting there, as we said, they've made a loss of 19 million, and that's going to come down. So the question is, can they clear the atmosphere before they run out of fuel? Because if they can't, they fall back to Earth, and if they can, they're in space, and then they're off. That's the analogy we're looking at. Yep. Look at their liabilities, their current liabilities. So the current liabilities is quite high. So what I usually do is when I'm looking at these numbers, I'm comparing the current assets which is this basically, that's this number here, to the current liabilities, which is this number here. Okay, so there are current liabilities, things we have to pay soon. You'll notice that the biggest number is this is the loans and borrowings. Now that might be so first of all, this looks absolutely fine, because they got 90 million of things which are cash or going to become cash soon, and they only have to pay 38 million soon. Okay, again, it's a startup, so it's a little bit we have to take these with a bit of a pinch of salt. Even if they can't sell the cars, they've still got enough cash to pay their liabilities, and most of the liabilities are the loans. And as I said, I expect that those loans are loans from their equity shareholders. So when they raise 450 million, they haven't raised 450 million as equity. It'll be a mixture of debt and equity.
And this isn't the same. This isn't the same as what you talk about in the past videos around servicing your debt.
No, it's no, it's not, because servicing your debt is if your debt is provided by somebody completely different to your equity. So if you take someone like Coca-Cola, for example, who I think we've talked about before, Coca-Cola's shareholders and the debt providers are two completely different institutions. I mean, by accident too, maybe, but this is financial structuring, if that makes sense. Okay, so for example, when I start a company, I tend to put a little bit of equity and then everything else is debt. And the reason I put it in as debt is I can get it out as debt, so I can just repay myself. It's nice and easy to get out.
Okay.
So when we look at the balance sheet is positive. They've got net assets, and down the bottom we can see that the share capital, so the total amount invested is 80 million pounds, which is the 81,499,998 plus the £2 of share capital. So those two numbers together make the equity investment. That's 82 million pounds. And they've lost so far about 19 million pounds. Okay, so you can start to see that if they carry on losing at that rate, then they're going to run out. They're basically going to go bust.
Is that the retained? So just for our viewers, Ted, is that the retained earnings just mentioned, or were you talking about the loss?
Yeah. So this retained earnings. So this number here.
Yeah.
This is the total amount of. So this is the total amount of profit, or in their case, loss they've made ever since they started trading.
Gotcha.
Okay. So I think we're looking at 1 year there. I'm looking at this. I'm thinking they actually they may have had a previous year, but effectively, in fact, we can just double check.
No, they started in 2019.
Okay, so they did. So yeah, and they've only got one set of accounts, 1 year of accounts. So that 8723203 should be
exactly the same as.
It should be exactly the same. It's not quite. In fact, it'll be. I'm not sure exactly why there's a difference.
Yeah, that's interesting.
Yeah. So and again, I don't worry too much about this. These are signed off by Ernst & Young as an auditor. Sure. They'll have checked. The numbers will add up. So I'm not going to kind of lose a huge amount of sleep over a few 100,000 there.
So about the cash, is that what we're going to get to, or is this?
In fact, right. it'll be here. So here's the loss for the year. So the retained earnings. Here's the loss for the year, which is from the profit and loss account. And there's this issue of share-based capital payments. So this is payments to staff and using shares instead of actual. So yeah, etc.
That's where it is. Okay.
So the cash flow, and again, this is only the cash flow for a startup. So this is basically saying how much fuel is it burning, how quickly. The bottom line says, they've burnt 68 million pounds of cash in the first year. So you can see that they've raised 82 million through equity. They've probably got another 100 million through debt, and they've burnt through about 68 million in total so far. Now, a lot of that is going to be things like, investment in, they've got down here the investment going on. So this is 5 million of purchasing property, plant and equipment, etc. And you can see here the issue of ordinary shares, stocking loans. So stocking loans is an interesting one. This was a new one to me, and the repayment of stocking loans. They buy their cars on credit. So they actually have specific loans. So rather than using their cash pile to buy the cars, what they're doing is that they're buying a car, and a finance company is financing the purchase of that car, and they're paying 7%, and then they repay the loan on that car when they sell the car, or 180 days. So basically, they've got to sell the cars within 180 days.
That's
So
interesting.
that's an interesting kind of different way of structuring. So you can kind of look at that and say, well, is that debt? Is that, you know, and it's a kind of it's a form of working capital debt financing, if that makes sense. And that's where the short-term loan comes in, because that'll be a short-term loan tied to the stock, and it'll probably be secured on the stock, if that makes sense.
That's an interesting point, actually, Ted, because if someone's watching this who's trying to sell to Cazoo, if you're going to talk about ROI, then an interesting angle would be, hey, we understand that you're buying your cars on debt and you've got to sell it within 180 days. For example, our software, our solution, you know, our product, etc., is going to help reduce that to maybe 100 days on average. So that means that they can save not only the money on the interest itself, but any money on the cost of stocking, storage, distribution, distribution. Yeah, interesting. Very interesting.
Those 43 million quid's worth of cars, they've got to be sitting somewhere in a warehouse or in a field somewhere.
Well, interestingly, they just announced, and it won't show up here, of course, but they just announced that they bought a company called Imperial Cars. That's it, for 201 million. And the reason why they bought them is because they kind of have nationwide spots, hub spots, where they can store, distribute the cars, and also help with after sales and collection as well. So it'll be interesting to see, because they obviously bought that because they feel they can get a much better return and spend less on the stocks and on storage and distribution and things like that, and plant equipment, etc.
Yeah, and I think it's interesting looking at that kind of business model. So it's kind of like, you know, do you want a centralized hub? You know, the great thing about this is I can buy a car. I don't have to worry about, you know, how far away it is from my house, because they'll deliver it. Now, you know, the distance from my house, this becomes the problem for Cazoo. So if you're sitting in the Outer Hebrides or in Aberdeen, and the car that you've just bought is sitting in Bristol, you know, Cazoo have basically got to get it all the way up to Aberdeen for you. So you can start to see that logistical, that cost of distribution, the separate line, if you remember, you know, that's only going to go up as well. And, you know, it's going to work well when the car I want is just up the road. It's not going to work so well when the car I want is, you know, the other side of the country. So there's a kind of a logistical kind of challenge going on here.
Very interesting.
So what's quite interesting, if we dig into the notes to the accounts, and I'm just going to whiz down. So a lot of this is about, you know, their kind of, you know, their how they account, their accounting standards, and just come down to some of the key the key notes we've got in here. So here we go. So this is quite interesting. So revenue is basically saying they're making all their revenue from private retail sales. So it's a retail base, although, you know, they're saying, you know, maybe we can go into the wholesale world as well. I'm not sure what non-metal is, I have to admit. It looks like they sold one company which was non-metal. I guess that's a plastic car. I have no idea. What else did we find out? I thought this was interesting. So here we've got the employees. So I'd just like you to get your calculator out, Moeed. So here are the wages, okay, which has got national insurance, etc., the share-based payment expenses. So they're spending £6.2 million on their staff, and the total number of staff during the period is 49. So if you divide 6,245,000 by 49,
it's not going to be it's not going to be evenly distributed, I'm sure, but it comes out to an average of 127, almost 127,500.
Absolutely, it does. 127. It's 127,000. So I my theory is a little bit of that admin space. I mean, somebody somewhere is making a lot of money.
Yeah.
Now, Alex Jesterman, you know, he's the director. You'd expect him to be highly paid. Okay. Well, this is including directors. Well, of that number, 485,000 is for the directors. And the highest paid director, who I reckon is Alex, is on 318,000. Alex isn't in this for the salary. Alex is in this for the capital gain. He's made his money by taking a company. He'll have a substantial shareholding of this, and he's looking to basically, you know, realize the gain that he can create that value. So it's a bit like, you know the lowest paid CEO in the NASDAQ.
No.
Is Elon Musk. Okay. Elon Musk, his salary is zero. He doesn't take a salary. okay, because it's all share based.
Yes.
And so Alex, so the directors, Alex is taking this. Here are the directors. So these are non-directors.
Wow.
So you've got a bunch of people here who are, you know, and you know, if you look at the sort of the team Alex has brought with him from Zoopla. So you know, he's obviously built a team who've experienced. They trust each other. They work well together. There's somebody in there, either a few individuals earning more than their fair share, or everyone's earning quite a high rate. You know, if I was an investor, I'd be scratching my head and thinking, hold on a sec, what am I actually investing in?
That's a really good point.
Am I investing in somebody just to kind of feather their nest, or am I actually investing in, you know, are these people, you know, what are the big salaries, and is that worth it?
I expect that's going to be a lot higher this year, because they hired, let me see my notes, Stephen Morana, Stephen Morana. He's the CFO, and he's known for his expertise in taking companies public, which I think is going to be one of the questions I ask you later on. But he's going to take a significant.
So he will probably come on as a director, I would expect, a main board director.
That's true.
And so he'll be part of these directors' emoluments here. So you'll be able to strip him out and look at the directors and non-directors, for example. So I thought that kind of jumped out at me. So property, plant and equipment, here they are. They're investing in leasehold property. They're improving it. Some computer equipment. They're buying computer vehicles for their team. That probably all sounds, you know, about right. You know, it seems expensive to be buying leasehold property. I'm not sure why they need leasehold, why they can't just rent. The intangibles, as we talked about, the development platform, you know, maybe there's an opportunity to create a white label where they can take, you know, the functionality and sell it to other people if this doesn't work out, you know, or maybe it has no additional value. So, you know, again, you know, if this doesn't work out, you can't put that on eBay and sell it. Okay, you can sell the property. This property you can sell for what you paid for it, give or take. But you know, you're not going to be able to sell the intangible. Here's the inventory, and so you know, as we talked about, the inventory. So 43,000. There's a little bit of a provision there, and so the inventory is held as security against stocking loans. So the loans are secured on the stock. So the person who's made the stocking loan is happy that if they don't, you know, basically if the company fails, they take ownership of the cars. Okay, so there's an important aspect here. I guess, you know, you need to read the legal agreement to make sure that, you know, when you buy the car, you're taking ownership and the stocking company doesn't. You know, if you buy the car from these guys and then they go bust,
you would hope
who owns
so.
the car? Is it you or is it the stocking company?
Yeah.
Well, read the small print, I think, is the answer there. So here we've got the trade and other receivables. So you remember the trade and other receivables is a very high figure. And they've got a lot of prepayments. So they've made payments in advance. So this could be, for example, sponsorship deals, which they've paid in advance. So that won't be. So you remember we talked about, you know, the sponsorship of the Premiership. Maybe they paid for it in 2019, but they're going to recognize it in 2020, for example. They reckon they got a lot of VAT recoverable. And I'm not a VAT expert, but
that seems high.
I know that. Well, it does seem high, but don't forget, you know, they've bought the cars, and if you buy a car, you expect to get the VAT back. Okay, so you can reclaim that VAT, but then when you sell a car, you have to add VAT on top.
Yep.
So at the moment, they're saying we've bought all these cars, but we haven't sold them, and therefore we can claim back the VAT on those cars. So those are the two big numbers that make up their trade and other receivables. Okay, and that kind of, you know, and then you've got some non-current, again, prepayments. So if you look here, this prepayments line here, what you're really saying is that they've spent, you know, if this is the sponsorship, and it kind of looks like it might be something to do with that, they've spent in 2019, they've spent 7.8 million on sponsorship, which relates to 2020, and 2.5 million that relates to 2021 and beyond, for example. That's really what they're trying to show there.
Is it the other way around? It says non-current on the right and then current on the left.
Yeah, so current is within the next year.
Right, not related to. Okay, so I was looking at the other way around. Yeah.
So non-current means further, you know, in the distance.
Right, that's going to be next year.
Current,
right. Okay.
Yeah, so the current will relate to 2020 and the non-current will relate to 2021 and beyond.
Gotcha.
Trade payables. So obviously they bought the car, they've got those stocking loans. So that probably looks okay. This is where we see the stocking loans. And I'll just see if I can find where I highlighted the I can't see the exact there's we're getting into kind of the share capital, and this is the sort of structure. You'll see they've got lots of Series A's and Series B shares, and I'm not sure exactly, they don't identify exactly what the difference is. You'll notice the shares are very, very low in value each.
Yes.
So they've obviously issued lots and lots of shares. They're trying to create liquidity here. So an example there is if you wanted to buy shares in Berkshire Hathaway, which is Warren Buffett's investment fund, one share today will cost you about $250,000. So you can think there's not a lot of liquidity in there because you've got to have $250,000 just to invest. Whereas here, what they're doing is that they're hopefully saying, the shares will actually be worth much more than that. And it'll create liquidity when it comes to flotation.
So what does this tell you about the business, right? What are the things to look like? What's the kind of summary of when you think about this business? If you're trying to do business with this company, for example, what are the kind of key 2 or 3 things that you would advise someone to think about?
I think the key thing to remember about this business is, and it kind of comes back to the Alex Chesterman and his history. So Love Film is a network effect. He's creating something where this is where the movies are, so everyone's got to subscribe, and everyone's subscribing because that's where all the movies are. Okay, we're talking ecosystems here. Zoopla was a very strong ecosystem. So you described it 100% accurately as the kind of the hub where all the properties are. So if I walk up to my high street, I see 50. Let's say 20 different estate agents. I've got to go to look in 20 different windows. I've got to visit 20 different estate agents' websites to find the property I want. Zoopla is merely where the estate agents can put their properties. So it's actually owned or part owned by the estate agents. They have an incentive to drive traffic to Zoopla. Now they're competing against each other, but they're also together, if that makes sense. So what they're trying to do is to use this as a way of selling their selling their properties, and they're trying to give a one-stop shop. So Zoopla works because everybody looks at Zoopla because that's where the properties are, and the estate agents put their properties on there because that's where everyone's looking. Okay, so we're back in this network effect. And what I've been struggling to come up with is what's the network effect for Cazoo?
Yes.
Because you could say, well, all the secondhand cars are available are on Cazoo. Well, they're not. I mean, for me, the network effect is still Auto Trader. Auto Trader is that's where all the listed cars are. There's quite a lot on eBay, but there's a lot of scams on eBay. I'm not convinced, but maybe he's building something which all of the dealers will start to deal through, so the dealers will start to put their cars on there. But then does that change the kind of the Cazoo guarantee that you're buying something which has been independently checked by Cazoo, and that could reflect on the admin expenses. So the admin expenses may be that they've actually had to check and analyze every single car, although I would add those expenses into the stock, because the value of your stock should be the cost of getting it to its present location and condition.
You are right that they do that. That is one of their value propositions. They do say that they check. Although what's interesting, what you said about, what if the dealers start to put their stuff on there, but that doesn't seem to be their business model, because that's another Auto Trader. And if they try to sell it, if they try to sell it to Cazoo, well, that means less profit for Cazoo. They would have to sell it at a higher price, which makes them uncompetitive.
Exactly. And so if you think about it, if you're buying a car, and a car, is generally speaking the biggest expense we make after our house. And if you're going to buy a car and a second-hand car, you're probably going to benchmark what it's worth by going to Cazoo and going to Auto Trader. I mean, I think you'd be crazy not to, and just see, there'll be a lot of people who, and as well as I do, who just go, I don't want to be ripped off. I don't want the risk of Auto Trader. I want Cazoo. I trust them. Okay.
Yes.
And that's where brand familiarity comes in. So what he's doing is he's building this trusted brand, which people then feel confident that, what you see is what you get. It's simple, it's easy, it turns up at my house, I can drive it around for 7 days. If there are any problems, they'll come and take it away. Now that's a significant issue, because now they've got to actually recover the vehicle.
Exactly.
The sort of no quibble money back guarantee, the warranties, etc., etc. So there's a lot of expense sitting around there, and I'm just looking at this thinking, this is, cars are low margin. The volume, if you get the volume, you can make a lot of money. The car dealerships make a huge amount of money, but it's a volume game, and that's what they're going for, is volume. And I'm struggling to see whether they're going to hit what is their critical mass volume, and whether they're going to be able to hit it.
Yeah, and there are a couple of other trends actually that are big risks for them. Number one is, in the UK, if we do move to fully electric cars, then pretty much, and if that really does happen, then pretty much all that stock that they have there, they've either got to shift it, or they're going to have to find another way of getting money back from those cars. So although that's less of a risk, I think, because of the amount of time involved.
Yes, I think there's a long time lapse. I mean, these guys, they've got to sell their cars in 180 days. Let me just share that screen again. So this was the one I wanted to show you. So the financial liabilities. Hopefully, you can see that on your screen now. You can see the stocking loan on earliest sale of underlying vehicle or 180 days. So basically, they're paying 7-day LIBOR plus 1.75%. They're paying 7.5 7-day LIBOR plus 3.75%. So it's probably costing them about 4% or 2%. You could call that. And so it's not expensive, and it's on. They've got to repay within 180 days. So they've basically got 180 or 120 days grace to sell the vehicle before they actually have to repay the loan, if that makes sense.
No, that makes sense. And
so,
here's the other trend.
The move to electric, the move to electric, I don't think is really relevant, because these guys will move at that speed, if that makes sense. So we're not getting electric overnight just like that. It's not going to wrong foot them. They're not going to be caught with a whole lot of stock that they can't sell, if that makes sense. They will manage, they will only buy stuff that they feel confident they can sell, if that makes sense.
Yeah, that makes sense.
We talked last time about Tesla. Should I buy shares? Should I not buy shares? This one, you can't buy shares because it's a private company.
Yes.
But I wanted to demonstrate this by saying that, next time you're sitting on the sofa and you suddenly see the kind of an advert and you go, oh, I wonder about that company. The accounts are there. You can go and have a dig around and look and start to, and by doing this, it improves your financial fluency. So, it may not be directly relevant to your particular area of expertise, but the ability to kind of draw these conclusions, to ask the questions that you've been asking, starts to show that you're understanding the numbers, you're thinking about it, so that if you do turn up to Cazoo and you are engaging with them, you can talk to them and actually come from a position of being informed effectively. Now that all the stock that they've bought is financed. They haven't purchased it themselves, they've borrowed the money to buy it.
So have they got the money to buy what you want to offer, especially if it's significant as well, when they are financing through debt the purchase of the very thing that they're selling?
So the 34 million that's sitting in their bank account is not used to buy cars. The financing of cars is ring.
Right. Okay.
It's completely separate. Okay.
Right.
So you can go to these guys and say, I don't care how much stock, if they're sitting on too much stock, because as long as they can shift it within 180 days, then whether it's profitable or not profitable, it doesn't matter. I can see that 34 million. They've raised another 200 billion, whatever it was. I think it's about 200 billion. They've got substantial amount of resources there. But look at the cash flow. Look at the cash flow, how quickly they're burning through that. So I think that, if we have a conversation in about 9 months' time, which is when they have to, by then they will have had to publish their 2020 accounts, I think we'll have a much better idea. I mean, right now we're looking at the space shuttle, and there's just lots of smoke around. And you're saying to me, Ted, is it going to get to the moon? And I'm going, it hasn't even cleared the tower yet, Moeed.
Right.
Okay.
Yeah.
Let's look at it in a year's time, and it'll be, it'll be about, I don't know, half a mile off the earth. We'll start to get a feel for, does it have the momentum? Is it going in the right direction? All the little indicators telling us, or is it starting to run out of steam, for example? So it'd be quite interesting to see.
Yeah, that'll be really interesting to see. Thank you for that, Ted. That was really interesting, and definitely food for thought. I hear
Pleasure.
about these guys all the time, but this is the first time I've really looked at their finances in the way that you have. That's great.
Excellent. Okay, good to speak to you again, Moeed.
Take care. Thank you.